Did you know that the Canadian economy might be in the midst of a recession right now? While it isn't official, that's what experts are warning might happen soon. The stock market has been shaky of late. Investors have been turning to safe haven assets like gold and silver, and there is the danger that a larger, full scale sell off could still be coming. Things may get worse. So, how can you protect yourself? Which stocks can you turn to in times like this? Today, I'm going over 10 stocks on the TSX that did well during the last market crash in 2022, when high inflation resulted in the market experiencing a significant downturn. First up is Cenovus, ticker symbol CVE. This oil and gas giant did well in 2022 as it proved to be a good hedge against inflation. Higher oil prices help these types of companies and stocks, and Cenovus was up nearly 70% that year. It blew past the S&P TSX Composite, which declined by 9%. The S&P 500 index was down more than 19%. If there's another downturn, however, things may not turn out nearly as well, because if oil prices don't end up rising, Cenovus may not do nearly as well. In 2022, oil prices hit highs of more than $100 a barrel. Right now, they're at around $60, so keep that in mind. But with fairly consistent demand for oil and gas, Cenovus may still be a safer investment than other stocks in a downturn. Plus, with the company recently acquiring Meg Energy, its business is larger and could potentially be more efficient and profitable down the road. This year, as investors have been turning to safe haven assets, Cenovus is once again doing well. It's up around 16% as of January 31st. The stock also yields around 2.9%, making it a good dividend option as well. Next up is Imperial Oil, ticker symbol IMO. Once again, this is another big oil and gas stock. In 2022, it rose by around 45%, coming in a bit behind Cenovus, but it was still an exceptional performing stock as well. For similar reasons to Cenovus, it benefited from rising oil prices. This year, it's doing well and is up 16% after the first month of the year. Imperial is the largest refiner of petroleum products in Canada and has iconic brands including Esso. And with ExxonMobil being its majority shareholder, it's a fairly safe stock to hang on to for the long term. It also yields 2.3%, giving investors an incentive to simply buy and hold. The third stock on this list is Canadian Natural Resources, ticker symbol CNQ. Yet another oil and gas stock, Canadian Natural Resources is the largest individual producer of crude oil in Canada. It has a lot to gain from rising oil prices. The company's business model is centered on a long life, low decline asset base, primarily focused on the Western Canadian Sedimentary Basin, with additional offshore operations in the North Sea and Africa. The company has a diversified portfolio as it also owns significant midstream infrastructure, including pipelines and power generating cogeneration plants. Back in 2022, the stock rose by 41%, slightly trailing Imperial's gains. This year, it's up again, around 9% as of the end of January. A big bonus with this stock is that its yield is far higher than both Cenovus and Imperial. At 4.5%, Canadian Natural Resources stock can be a great buy for not only stability, but also to generate a ton of dividend income. In at number 4 on this list is Suncor Energy, ticker symbol SU. I promise there are other stocks other than oil and gas on this list, but the top 4 all belong to this sector. Suncor is an iconic energy company in Canada, based out of Alberta. It has a fully integrated business as it mines for bitumen, refines it, and sells it at the pump. It has mining operations and operates major refineries across North America. It also manages the Petro-Canada retail and wholesale network. This is an excellent energy stock to own, and in 2022, it rose by just under 36%. This year, it's up around 18% after the first month of the year. Its dividend yields 3.3%, as this too is another solid option for income investors. Next up is the first stock that isn't from oil and gas, and that's Dollarama, ticker symbol DOL. Dollarama has a robust retail business with its dollar stores being prevalent all across Canada. Its stores are well maintained, unlike many US dollar store chains, and are attractive places for consumers to shop in. Although they have raised prices and now have many items around $5, they have continued to do well in attracting customers. The company's resiliency has made it a solid growth stock over the years. In 2022, it rose by 25%. This year has been a bit tougher with the stock down 10% as of the end of January. It has a high valuation, which isn't making it easy for it to rise a whole lot higher. But with the company expanding into Mexico and also Australia, its growth prospects remain encouraging. As a long-term investment, it's still an attractive option. And in a recession, the business may still do well and attract many bargain hunters. It does pay a dividend, but the yield is just 0.2%. Growth and stability will be the main reasons to want to buy this stock. We're halfway done. And at number 6 is Bombardier, ticker symbol BBD.B. This is a bit of a surprising one because Bombardier generally hasn't been a good stock to own, but in 2022 it rose by more than 24%. It has been a volatile investment, and I think it's probably the riskiest one on this list as a long-term buy. Between 2004 and the end of 2024, the stock actually declined by 29%. Think about that for a second. As a 20-year investment, it actually declined significantly, not what you'd expect for a long-term holding. This is a company that typically hasn't had a good track record for success, and it's had plenty of performance and quality issues in the past. Nowadays, with the Canadian government investing more domestically, however, it's been one of the hotter buys on the TSX. In 2025, it's skyrocketed by nearly 140%. This year, its returns are flat after 1 month. I'd be careful with this one, but I've included it on this list because it did prove to be a big winner in 2022. I just don't know if I'd count on it being able to repeat that performance again in a down year. Next up at number 7 is Pembina Pipeline, ticker symbol PPL. This is the last oil and gas stock on this list. Pembina has an extensive and integrated network of pipelines that transport crude oil, natural gas, liquids, and natural gas. Its business is heavily anchored by long-term fee-based and take-or-pay contracts, which provide highly predictable cash flows and a great deal of consistency and stability for investors. The company has significantly increased its scale by fully consolidating the Alliance Pipeline, and it's spending over $1 billion to grow production in multiple regions. Back in 2022, Pembina's stock soared by just under 20%. This year, it's once again up around 8% as of the end of January, proving to be a fairly stable investment. And at 4.9%, it offers a fairly high yield, making it another attractive option for dividend investors. At number 8 is Intact Financial, ticker symbol IFC. Intact is the largest provider of property and casualty insurance in Canada. It provides auto and home insurance and also insurance options for businesses. It has been a growth beast over the years, acquiring and integrating 19 companies since 1988. The company invests heavily in data science and AI, giving it an advantage in the industry as a way to optimize its pricing and risk strategy. Its goal is to grow its operating income by 10% annually. Like with Dollarama, the company's growth was likely a key reason for the stock's impressive gains in 2022 when it rose by 19%. Typically, financial stocks don't do well in a downturn, and that's a reason why Intact may not be a guarantee to do well if there's a significant downturn again in the near future. This year, as of the end of January, it's down 13%. But also like Dollarama, it may be a good long-term investment. However, I wouldn't bank on this outperforming the market again if there's a recession on the horizon. Next, at number 9 is Saputo, ticker symbol SAP. Saputo is a top dairy processor in the world, based out of Montreal. The company makes a wide range of products and operates in 3 main segments: retail, food service, and industrial. It has also been a growth-oriented business over the years, acquiring and integrating many companies along the way. The consistent and ongoing need for its products is what can make it a good and stable investment to hang on to, even in times of turmoil. Back in 2022, the stock rose a little under 18% for the year. And this year, as the end of January, its returns were flat. It might not be much of a growth stock these days, but it can be a safe place to put your money into if you're worried about the market. At 1.9%, it also offers a decent dividend. Lastly, in at number 10 is Loblaw, ticker symbol L. The grocery retail giant is another great example of a stable business you can invest in. Regardless of whether economic conditions are good or not, there's going to be demand for its products. By selling day-to-day necessities, Loblaw is in a good position to do well in any type of market. In 2022, its shares were up over 15% as it also generated solid double-digit gains. Through January this year, it was down around 1%, but that's still fairly stable. One way you can gauge a stock's stability is through its beta value, which tells you how much it moves in relation to the overall market. At just under 0.5, that suggests this is a low volatility stock. A stock that follows the market closely would be at a beta of 1.0. Loblaw is far below that. Its dividend yield of 0.8% may be a bit underwhelming, but it can still generate some recurring income for you. Loblaw can make for a good investment if you want to diversify your portfolio, as grocery stores may not be exciting, but they can be safe places to hide out in. And if there's a downturn in the economy, there may be more interest in the stock as a safe haven investment, so it could potentially rise higher. So that's 10 stocks. You may also want to consider some ETFs, and I've made a video on some great dividend ETFs that pay monthly. You can check out this video for that. I'll also cover some low volatility ETFs that may be attractive to own in a downturn in a future video. The big takeaway is that there are many different types of stocks and investments to consider, even if you're worried about the state of the economy right now. If you have other types of stocks you'd like me to cover, let me know in the comments. What did you think of these ones, and are they ones that you're thinking of buying today? Let me know. If you enjoyed this video, please leave a like and be sure to subscribe for more. Thanks for watching.